Imagine you are a passenger on a massive commercial airliner. In the back of the plane, there is an absolute massive party going on. The stock market is the DJ, and it is hyping up the next big song. Everyone is drinking champagne. Everyone is celebrating. People are whispering about the next big technology breakout. They are throwing money at rumors of a massive, new SpaceX initial public offering. But if you walk up to the front of the plane and open the heavy door to the cockpit, you will see a terrifying reality. The two pilots are screaming at each other over the flight plan. A massive red warning light is flashing on the dashboard, and the autopilot system is slowly starting to disengage. This is exactly what is happening in the global financial system, right this very second. Our latest data reveals a deeply dangerous market complacency. The crowd is completely ignoring a massive brewing storm regarding Federal Reserve leadership. Instead, they are chasing individual stock performance and ignoring the structural foundation of the economy. Today, we are going to look past the headlines. We are going to trace the invisible forces moving the smart money, and we will give you the exact playbook to protect and grow your wealth, while everyone else is dancing on the edge of a cliff. Let us start by understanding why the crowd is so distracted. Human beings are wired with something psychologists call salience bias. To understand this, we have to go back thousands of years. Imagine our ancestors walking across the open plains. They survived by paying immediate attention to the most obvious and vivid threats or rewards. A sudden rustling in the bushes, a bright red piece of fruit on a tree. We evolved to react to what is loud and clear and right in front of our faces. We did not evolve to understand slow-moving abstract dangers, like a gradual shift in the weather patterns that might cause a famine 3 years from now. In the modern financial world, this ancient wiring works against us. The crowd is exhibiting profound salience bias. The news flow today is completely dominated by extremely loud and vivid narratives. We hear about a potential blockbuster public offering from SpaceX. We see sharp, massive moves in companies like Meta and Micron and Newmont. These stories are tangible. You can easily imagine rockets going into space. You can easily understand a social media company making billions in ad revenue. These stories offer immediate emotional gratification or immediate fear. But out there in the background, there is a slow-moving abstract danger. There are reports of severe political friction surrounding the Federal Reserve leadership. There is a developing investigation involving Chairman Jerome Powell. There is pointed aggressive criticism from powerful politicians, like Senator Elizabeth Warren. To the average investor, this just sounds like boring Washington politics. It feels distant. It feels complex. It feels like a slow-moving famine that we do not need to worry about today. So the herd ignores it. The herd chases the individual winning stocks. They are operating under the dangerous assumption that the macroeconomic playing field is stable, simply because it has been stable for a very long time. This is a classic historical failure. People fail to price in structural risk until the exact moment it becomes an acute, unavoidable crisis. You need to understand why the Federal Reserve is so important. It is not just a bank. It is the anchor institution of the entire global financial system. To really grasp this, we have to travel back to the year 1913. Before the Federal Reserve existed, the United States economy was subjected to brutal and devastating banking panics. Banks would run out of money. People would lose their life savings overnight. The system was incredibly fragile, so the Federal Reserve was created to be the lender of last resort. It was designed to provide a stable foundation, but the most important feature of the Federal Reserve is its independence. It was specifically designed to be separated from everyday political pressure. Why does that independence matter so much? Let me tell you a story about a man named Paul Volcker. In the late 1970s, the United States was facing a terrifying economic monster called stagflation. Inflation was completely out of control. The cost of living was skyrocketing and destroying the middle class. Paul Volcker became the chairman of the Federal Reserve. He knew that to kill inflation, he had to raise interest rates to punishingly high levels. He had to make it incredibly expensive to borrow money. This caused a massive recession. People lost their jobs. Car dealers sent him the keys to unsold vehicles in protest. Politicians were furious with him, because high unemployment ruins political campaigns. But Volcker did not care about getting reelected. He was independent. He held his ground. He crushed inflation and set the stage for decades of economic growth. If the Federal Reserve had been controlled by politicians back then, they never would have allowed him to do what was necessary. They would have chosen short-term popularity over long-term survival. This brings us to the terrifying reality of today. The political friction surrounding Chairman Powell is not just noise. It represents a potential crack in the foundation of that vital independence. If the leadership of the central bank is weakened or distracted or politically compromised, its ability to react to a crisis becomes completely unreliable. Think of it like this. The Federal Reserve is the foundation of a massive skyscraper. The US dollar is the steel frame, and all the global markets are the glass windows. The credibility of the Federal Reserve is what keeps the dollar as the world reserve currency. It is the primary driver of risk. Free rate calculations all over the entire planet. When investors all over the world see political instability at the Fed, it creates a negative feedback loop. Leadership uncertainty breeds policy unpredictability. When policy is unpredictable, the market demands a higher risk premium. Let us break down what a risk premium actually is. Imagine you have two friends asking to borrow $1,000. The first friend has a perfect credit score. He has had the same stable job for 10 years. He is calm and predictable. You might lend him the money and only ask for a tiny bit of interest, because there is very little risk. Your second friend is currently going through a massive, unpredictable life crisis. He is arguing with his family. He is changing jobs every week. If you lend him the money, you are going to demand a massive amount of interest. You need to be compensated for taking on that extra danger. That extra interest is the risk premium. When global investors look at the United States and see a central bank fighting with politicians, they start treating the United States like that second friend. They demand a higher risk premium to invest their capital. This causes global capital flows to hesitate. It tightens financial conditions everywhere without the Federal Reserve. Even having to officially raise interest rates, it challenges the very concept of the Fed put. The Fed put is the long-held belief that if the stock market ever crashes too hard, the Federal Reserve will magically step in and save everyone by printing money and lowering rates. But if the central bank is paralyzed by political investigations, who is going to save the market? We are witnessing a stress test of institutional integrity, and the outcome has massive systemic implications. The smart money knows this. The legendary contrarian investors are looking way past the shiny headlines. They engage in something called second and third order thinking. First order thinking is simple. It says there is political noise at the central bank, but my tech stocks are going up today, so I will ignore it. Second order thinking goes deeper. It says this political noise will eventually erode policy predictability. Third order thinking is where the massive wealth is made. Third order thinking says if policy is unpredictable, then the implied volatility of the entire market is currently mispriced. It means the cost of portfolio protection is dangerously low right now. The smart money is not trying to guess the next quarterly earnings report for a random software company. They are positioning their portfolios for a massive regime shift, where institutional stability is absolutely no longer guaranteed. This leads us to the critical concept of insurance. In the financial markets, you can buy insurance against a crash. One way the smart money does this is through long volatility instruments. Think of the stock market like a massive highway. Right now, the weather is beautiful. Everyone is driving fast and having a great time. Because the weather is so nice, car insurance is incredibly cheap. Volatility is basically the price of market insurance. Right now, the herd is so complacent that financial insurance is selling for pennies on the dollar. The smart money is quietly buying up all this cheap insurance before the storm clouds break. They are buying things like far out of the money, put options on the S&P 500 index. A put option is simply a financial contract that explodes in value. If the market crashes, they are spending a tiny amount of money today to guarantee a massive payout if the system breaks. But options are complex. There is another much older form of insurance that the smart money is accumulating: real assets, specifically gold. Let us look at the sector radar from our latest analysis. We are highly bullish on the materials sector, represented by the ETF ticker XLB. We are specifically looking at miners like Newmont and industrial heavyweights like Worthington Steel. Why gold? Why materials? To understand this, we have to look at the history of money itself. For thousands of years across countless empires from the Romans to the British, gold has been the ultimate store of value. It is the only financial asset that is not simultaneously someone else's liability. A dollar bill is a promise from the U.S. government. A corporate bond is a promise from a company. But a physical ounce of gold is nobody's promise. It just is. In the year 1971, President Richard Nixon shocked the world. He completely severed the tie between the UU dollar and physical gold. He created a system based purely on trust in the government. This is called fiat currency. For the last 50 years, this trust-based system has worked fairly well. But when you have a crisis of confidence in the central bank that issues the currency, people instinctively flee back to the hardest asset on earth. Gold is the ultimate hedge against systemic institutional failure. When politicians argue and print too much money, gold quietly holds its purchasing power. Our technical analysis shows firming support in the gold sector. Capital is actively seeking a safe haven. Now let us look at the sectors we are extremely bearish on. First is the consumer discretionary sector, represented by the ETF ticker XLY. This sector includes companies that sell things people want, but do not absolutely need. Think luxury cars. Think expensive vacations. Think high-end electronics. If a true crisis of confidence hits the central bank and financial conditions suddenly tighten, the economy will slow down rapidly, the very first thing everyday people do. In a slowdown is stop buying luxury items. This sector is acutely vulnerable to the macro risks the herd is ignoring. We are also deeply bearish on the financial sector, represented by the ETF ticker XLF. You might think that banks would do well, but extreme policy uncertainty is an absolute nightmare for a bank balance sheet. Banks make money by carefully managing the spread between short-term borrowing costs and long-term lending rates. This is called the yield curve. It is like the thermometer for the entire economy. When the central bank is unpredictable, the yield curve thrashes around violently. This disrupts lending. It massively increases hedging costs. It creates terrifying volatility in the underlying bond portfolios that these banks rely on for survival. The technology sector, represented by XLK, is currently neutral, but leaning heavily toward danger. Yes, individual companies like Micron are making big moves based on specific news, but the technology sector as a whole is basically a giant bet on the future. These companies are valued incredibly high based on profits. They hope to make 10 or 20 years from now. To justify those high prices, they need interest rates to remain low and predictable. If the macro risk premium suddenly spikes, tech stocks will suffer a disproportionate and violent correction. Let us dive deeper into the technical outlook. The broader market, represented by the S&P 500 ETF ticker SPY, is currently just digesting its recent massive gains. It looks calm on the surface, but underneath the surface, it is incredibly vulnerable to a sudden downside catalyst. A major negative news story regarding the Federal Reserve investigation could trigger a massive cascade of selling. We are watching fixed income ETFs very closely, specifically ticker IEF, which tracks 7 to 10-year Treasury bonds. Right now it is coiled incredibly tight. It is barely moving. This indicates massive indecision in the market. Investors are completely frozen. They are trying to weigh the risk of sticky inflation against the sudden, desperate need to buy safe haven assets. The key technical signal we are waiting for is a violent breakdown of recent support levels in the major indices, accompanied by a massive spike in trading volume. That will be the signal that the herd has finally woken up to the danger. The absolute most important indicator to watch in the coming weeks is the US dollar itself. Historically, in times of global panic, capital floods into the US dollar as the ultimate safe haven. It is considered the cleanest shirt in the dirty laundry basket of global currencies. But we might be entering a paradox. If the primary source of the global panic is the American central bank itself, the dollar might actually weaken. A true crisis of confidence could cause global investors to dump dollars and buy gold instead. If we see the dollar plunging while gold is skyrocketing, it will be the ultimate confirmation that the system is breaking. Furthermore, keep a close eye on the long end of the yield curve. If 30-year Treasury yields start exploding higher, it means the bond market is terrified that the Federal Reserve is too distracted by politics to fight inflation. Finally, credit spreads. A credit spread is the difference in interest rates between super safe government bonds and risky corporate junk bonds. Right now, spreads are tight. People are blindly trusting risky companies. But if those spreads suddenly blow wide open, it will be the canary in the coal mine for a massive stock market crash. So how do the greatest investors in history handle a moment like this? Let us open the Titan playbook. We need to study the masters of market psychology. Let us talk about Sir John Templeton. He was one of the greatest global stock pickers of the 20th century. He became a legend at the start of World War II. When the war broke out, Europe was in chaos. The stock market was plunging into an abyss of despair. Everyone was selling in absolute panic. What did John Templeton do? He borrowed money and bought 100 shares of every single stock on the New York Stock Exchange. That was trading for less than $1. He bought the companies that were facing bankruptcy. He bought the most hated assets on earth. Why? Because he understood the emotional cycle of markets. He famously stated that bull markets are born on pessimism. They grow on skepticism. They mature on optimism. And they die on euphoria. Right now, as the herd cheers for the SpaceX IPO, we are clearly in the euphoria phase. Templeton would be quietly walking away from the party and looking for deeply discounted insurance. Then we have the Oracle of Omaha, Warren Buffett. His most famous piece of advice is a permanent law of financial physics. You must be fearful when others are greedy, and you must be greedy only when others are fearful. Look at our data right now. We have quantified the current environment. Market sentiment is currently sitting at an extreme 85%. That is pure blinding greed. Meanwhile, our measure of systemic risk is glowing red at 65%. And Federal Reserve policy, clarity has completely collapsed to a miserable 30%. The math is screaming at us. When sentiment is at 85, but clarity is at 30, you are standing on a trap door. Buffett would not be aggressively buying tech stocks right now. If you look at his history during the 2008 financial crisis, he did not chase the falling knives. He waited patiently with a massive mountain of cash, and when the banking system was on the absolute brink of collapse, he stepped in and dictated his own terms to massive companies, like Goldman Sachs and General Electric. He demanded incredibly favorable deals that regular investors could never get. He was greedy only when the entire world was drowning in fear. So how do you actually build a portfolio to survive this specific environment? You need a fortress. We recommend the 55-35-10 seesaw asset allocation model. This is designed perfectly for macro uncertainty. Let us break down every single piece of this strategy. 55% of your portfolio should be allocated to broad market equities. We are not telling you to sell everything and hide in a bunker. That is a loser strategy. Human innovation never stops. Corporations will continue to generate earnings over the long run. You want to use a broad, low-cost ETF like SPY or VTI. This keeps you exposed to the upside. If the market continues to melt up irrationality, it ensures you do not miss out entirely. But we are capping this exposure at 55% to prevent catastrophic ruin. 35% of your portfolio must go into the safe defensive bucket. This is the shock absorber for your financial vehicle. In a normal environment, this might be 20%, but today we must play heavier defense. This bucket should be heavily tilted toward real assets and high-quality bonds. You want exposure to physical gold through an ETF like GLD. You want exposure to the material sector through XLB to protect against structural inflation. And you want exposure to mid-duration government bonds through IEF. When the equity market hits a massive pothole, these assets will surge in value and keep your overall net worth stable. They are the counterweight to the panic. The final 10% of your portfolio must be held in cold, hard cash. Many people say cash is trash because inflation eats away at its value. In normal times, they are right. But in a time of extreme overvaluation and systemic risk, cash is not trash. Cash is a weapon. Cash is pure financial optionality. When the trap door finally opens and the herd panics and sells their favorite tech stocks at a 50% discount, you will be standing there with dry powder. You will have the emotional calmness and the physical capital to buy world-class assets at generational bargain prices. Cash allows you to be greedy when others are fearful. But having the right allocation is only half the battle. You also need survival mechanics. You need a rigid emotional framework for deploying your capital. This is where dollar-cost averaging comes into play. Dollar-cost averaging means you take a fixed amount of money and you invest it on a strict schedule. Maybe it is $500 every single Monday. You do this regardless of what the news says. You do this if the market is up, and you do this if the market is crashing. Think of it like a farmer planting seeds. If you try to guess the weather and plant all your seeds on one single day, a sudden frost could wipe out your entire crop. But if you plant a few seeds every single week, you guarantee that at least some of them will hit the perfect weather conditions to grow massive roots. Dollar-cost averaging completely removes human emotion from the equation. It forces you to buy more shares when prices are cheap, and fewer shares when prices are expensive. Finally, you must implement the 50% rule for risk management. The biggest mistake amateur investors make is riding a losing stock all the way down to zero because their ego refuses to admit they were wrong. The 50% rule is a mechanical circuit breaker for your ego. Before you even buy a risky individual asset, you determine your absolute maximum pain threshold. Let us say you buy a speculative mining stock. You decide in advance that you will not tolerate a loss greater than 20%. If the stock drops 20%, you do not check the news. You do not go on social media to read opinions. You mechanically, ruthlessly sell exactly 50% of your position immediately. This accomplishes two massive psychological victories. First, it stops the bleeding. It guarantees that this single bad decision will not destroy your entire portfolio. Second, it clears your mind. By taking half the chips off the table, you remove the panic. You can now analyze the remaining 50% with a calm, rational brain. You survived to fight another day. We are standing at a critical juncture in economic history. We are witnessing a profound and terrifying divergence. There is a massive gap between micro-level optimism and macro-level fragility. The individual corporate stories sound amazing. The rockets are launching. The artificial intelligence algorithms are learning. But the ocean that all these companies are swimming in is becoming deeply unstable. The anchor of the global system is cracking under political pressure. In financial markets, the risks you willingly ignore are exactly the ones that will define your long-term returns. Do not be the person dancing in the back of the airplane while the warning lights flash in the cockpit. Stay incredibly disciplined as the foundation shifts beneath the celebratory surface.